The year before you retire can end up being one of the most expensive years of your life, not because of inflation, and not because your pension is too small, but because of simple mistakes that many people don't realize they've made until HMRC sends them a letter. For some people, it's a tax code that quietly takes too much money every month. For others, it's a pension withdrawal made at the wrong time that creates an unexpected tax bill. And for thousands of future retirees every year, it's missing a refund they were actually entitled to claim. The frustrating part is that many of these problems could have been avoided with just a few checks before retirement officially begins. So in today's video, we're going to walk through the most important HMRC mistakes to avoid during your final year before retirement, what they could cost you, and the simple actions that may help protect your pension income from day one. Make sure you stay until the end because the final mistake is one that catches many people who believe they'll only receive the state pension. By the time they discover the issue, fixing it becomes much harder. Let's begin with something that seems incredibly small but can affect every pension payment you receive. Many people assume that once they stop working, HMRC automatically knows exactly how much tax should be collected. In reality, retirement is one of the biggest changes to your financial situation, and government systems don't always update instantly. During your working life, your employer deducts tax through pay. After retirement, your income may come from several different places. You could receive the state pension. You might start drawing from a workplace pension. Perhaps you have a private pension, a small rental property, part-time consulting work, or savings interest. Each source can affect your overall tax position. If HMRC's records don't accurately reflect those income sources, your tax code may no longer be correct. That can lead to two very different problems. The first is overpaying tax. Your monthly pension may be smaller than it should be because too much tax is being deducted. The second problem is often even more unpleasant. Not enough tax is collected throughout the year, leaving you with a bill later that you weren't expecting. Neither situation is ideal. That's why one of the smartest things to do before retirement is review your tax code instead of assuming everything is already correct. It only takes a few minutes, but it could prevent months of incorrect deductions. Now here's something else many future retirees don't realize. The state pension itself counts as taxable income. This surprises people because tax usually isn't deducted directly before the money reaches your bank account. Seeing the full payment arrive often gives the impression that it's tax-free. But that's not how the system works. Instead, HMRC generally takes your total taxable income into account. If you receive additional pension income or other taxable income alongside your state pension, that combined amount may increase the tax you owe. This doesn't automatically mean you'll face a large tax bill. It simply means your overall retirement income should be viewed as one complete picture rather than treating each payment separately. Imagine someone retiring in November. For the first half of the tax year they received employment income. Then they begin drawing a workplace pension. A few months later, their state pension starts. Without reviewing how those income streams fit together, it's easy to misunderstand how much tax should actually be paid. That's why the transition into retirement deserves far more attention than most people give it. Another common mistake happens during the final months of employment. Many workers retire partway through the tax year. Perhaps they finish in July, maybe September, or even December. What they don't always realize is that the amount of tax deducted while they were working may have assumed they'd remain employed for the entire tax year. When employment ends earlier than expected, some people discover they've actually paid more tax than necessary. In certain situations, that could mean they're entitled to a refund. Unfortunately, many retirees never check. They simply assume everything balances itself automatically. Sometimes it does. Sometimes it doesn't. And if you never review your situation, you may never know whether money is owed back to you. That's why your final payslip, your P45, and any pension paperwork become especially important during this transition. Keeping those documents organized makes it much easier to confirm whether everything has been calculated correctly. The key message here isn't to assume you've made a mistake. It's to avoid assuming everything is perfect without checking. A simple review today can be much easier than trying to correct several months of records after retirement has already begun. And in just a moment, we'll talk about another HMRC requirement that many retirees don't discover until they receive an unexpected letter asking for information they didn't even know they needed to provide. One of the biggest misunderstandings about retirement is the belief that once you stop working, your paperwork is finished forever. For many people, that's true. But not for everyone. Depending on your financial situation, HMRC may still expect you to report certain types of income even after you've left the workplace. This is where many new retirees become confused. They hear that most pensioners don't need to complete a self-assessment tax return, and assume the rule applies to everyone. In reality, it depends on where your income comes from. For example, if all of your tax is collected correctly through pay and you have no other taxable income, you may not need to file a return. However, if you receive rental income, income from overseas, self-employment earnings, significant investment income, or other untaxed income, your responsibilities could be very different. The important point isn't to guess. It's to know which category you fall into. Ignoring a filing requirement because you assumed it didn't apply can sometimes lead to penalties, even if the amount of tax involved is relatively small. That's why retirement shouldn't be viewed as the end of financial administration. It's simply the beginning of managing your income in a different way. Now let's move to another mistake that costs people money every single year. Many retirees experience changes in income during the first few years after leaving work. Perhaps you decide to take money from a personal pension later than expected. Maybe you start receiving income from savings. Some people sell investments. Others begin renting out a property. Some even return to part-time work because they enjoy staying active. Every one of these changes can affect your tax position. The mistake is waiting until the end of the tax year before telling HMRC. By then, your tax code may have been wrong for months. That can create an unpleasant surprise. Either you've paid too much and need to wait for a refund, or you've paid too little and suddenly receive a tax bill you never planned for. Neither outcome is ideal. Keeping your information up to date whenever your income changes gives HMRC a better opportunity to calculate your tax correctly throughout the year instead of correcting everything afterwards. Now here's something that doesn't affect every retiree, but for those it does affect, the consequences can be surprisingly serious. If you receive certain public sector pensions or live overseas while collecting a UK pension, you may occasionally be asked to confirm that you're still eligible to receive your payments. These requests can sometimes include confirming your current address or completing what's often known as a life certificate. Most people complete the paperwork without difficulty. The real problem occurs when letters are sent to an old address. Imagine moving home shortly after retirement. You're busy settling into a new routine. Boxes are everywhere. Mail is still arriving at your previous property. Weeks later, you discover an important letter was never answered. That simple oversight could delay future pension payments until the situation is resolved. It's one of those problems that's completely avoidable with a quick update after moving. Before retirement, make a checklist of every organization that needs your current contact details, not just HMRC, but pension providers, banks, and any other institution connected to your retirement income. A few minutes updating your records today can prevent weeks of frustration later. Now let's talk about one of the most overlooked tax benefits available to retired couples. Every year, thousands of eligible households leave money unclaimed simply because they never realize the relief exists. If one partner has income below the personal allowance while the other pays basic rate income tax, there may be an opportunity to reduce the household's overall tax bill through marriage allowance. Many couples assume this is applied automatically. It isn't. In eligible cases, it generally requires an application. Even more surprising, some claims may be backdated if the eligibility rules were met in previous years. That means people sometimes discover they've been entitled to savings they never received. The amount won't transform your retirement finances overnight. But every pound matters when you're living on a fixed income. Whether it's paying for higher energy bills, covering prescriptions, or simply creating a little extra breathing room each month, keeping more of your own money is always better than leaving it unclaimed. And there's one final issue that every future retiree needs to understand, because it could become one of the biggest tax changes facing state pension recipients over the next few years. We'll explain exactly what it means, why experts are watching it closely, and the simple question you should ask yourself before you retire. The final mistake isn't really a mistake at all. It's failing to prepare for a change that's gradually becoming more important every year. As the full state pension continues to increase under the triple lock, more retirees are finding themselves much closer to the personal allowance than ever before. For years, many people assumed that receiving only the state pension meant tax simply wasn't something they needed to think about. But the gap between the annual state pension and the personal allowance has become much smaller. That means even a modest amount of additional income, a small workplace pension, interest from savings, rental income, or part-time work could affect your overall tax position. The key isn't to panic. The key is to understand your own situation before retirement begins. Ask yourself a few simple questions. Will the state pension be your only source of income? Will you also receive a workplace or private pension? Are you planning to withdraw money from a pension pot over the next few years? Do you expect income from investments or property? The answers determine far more than most people realize. Planning ahead gives you time to understand how your retirement income fits together instead of trying to solve tax issues after they appear. And that's really the theme running through everything we've discussed today. Retirement isn't just about stopping work. It's about managing a completely different financial life. The people who experience the smoothest transition usually aren't the wealthiest. They're the ones who prepare. They check their tax code. They understand how their pension income is taxed. They review whether they've overpaid tax before leaving work. They keep HMRC informed when their income changes. They update their contact details after moving. They claim reliefs they're entitled to instead of leaving money on the table. And they take a little time to understand how future tax rules may affect them. None of these tasks are particularly complicated. But together, they can make a significant difference to how much money stays in your pocket during retirement. Before we finish, here's a quick recap. If you're in your final year before retirement, make sure you've reviewed your tax code. Check whether your retirement date could leave you entitled to a tax refund. Understand whether you'll need to report any additional income. Keep HMRC updated whenever your financial circumstances change. If you've moved house, confirm your address with every pension provider. If you're married or in a civil partnership, check whether you're eligible for marriage allowance. And finally, look at all of your expected retirement income together, not one payment at a time, so there are no surprises after you stop working. A little preparation today could save you hundreds of pounds and a great deal of unnecessary stress tomorrow. If you found this guide helpful, take a second to support the channel by clicking the like button and subscribing. We publish straightforward UK pension, HMRC, state pension, and retirement updates designed to help you stay informed without the confusing jargon. Also, let us know in the comments, are you retiring this year, or have you already retired? Your experience could help someone else avoid an expensive mistake. Thanks for watching, take care of yourself, and I'll see you in the next video.